This is Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg, in for Jumana Bersechi. And we're starting this hour with breaking news. The U.S. government is going dark as the clock ticks past midnight in Washington. As you can see there, a shot of Capitol Hill. Congress has failed to reach an agreement after Democrats rejected a stopgap funding package that did not address its demands. The last vote that we did see actually came on Tuesday night, and it failed on a vote of 55 to 45. Republicans needing a few Democrats to get on board if they actually wanted to avoid the shutdown. Seemingly, that is not the case right now. So as the clock ticks past midnight, we are now officially in a U.S. government shutdown, the first since 2018. So plenty to digest right now. Let's bring in Bloomberg's Miles Miller, who is following the story very closely for us from London. Miles, talk to us about how we got here. What happened? What didn't happen? And maybe where are we at right now?
Yeah, so the whole thing breaks down to fights over health care, right? Part of it is about Obamacare funding. That's the national policy that made health care a priority for Americans and made it a tax, and so everybody has to have health care, and it broke down over Obamacare premiums. In addition to that, it broke down over Medicaid cuts and limits to Trump's ability to block spending as it relates to money that's already been approved by Congress. Now, the Democrats avoided this the last go-round with Senate Minority Leader, Senate Democratic Leader Chuck Schumer breaking with Democrats and making sure that that bill passed the first time around. That wasn't the case this time, wanting to play hardball and wanting to show that they would not capitulate to the demands of the Trump administration. So what does this mean? 750,000 government workers will be furloughed as it relates to this. And what we know is that a bunch of national services are going to be disrupted. Everything from passports and visas on hold to federal oversights of the markets and workplace complaints as well. We also won't get our economic data in a timely fashion. The Labor Department's jobs report scheduled for Friday won't be released. Inflation and GDP updates are also frozen, along with many Treasury tax functions. That means that the Federal Reserve and investors are going to be basically flying blind without economic data. And we'll see how long this goes for. It all depends on whether they can come to a consensus. But we knew that this shutdown was going to happen because Mike Johnson, the House Speaker, decided to send his part of Congress home, and so that meant that the Senate was passing that was going to vote on that stopgap measure, and then it would go nowhere because there would be nobody to vote on it.
Right. And Miles, just as you were speaking there, we're actually getting some headlines from Senators Chuck Schumer and Hakeem Jeffries actually saying that the Democrats are ready to find a bipartisan path, of course, now as we're 3 minutes into the shutdown. You mentioned what we've seen in the past with similar shutdowns, Miles. How does this compare? How is this different, especially if we take a look at it from the president's side and some of the rhetoric that we're hearing from him?
Right, yeah, this is a little bit different because, the last time it was not in the same situation. We have got one-party rule in the United States with the House, the Senate, and the White House all controlled by Republicans. And so they really do need Democrats to come and meet them where they are to figure out how to avoid this going any further. We also saw the Trump administration try to take pains to make this a Democratic-led shutdown and to make that messaging. They got that messaging out days before. So try as they might, Hakeem Jeffries and Chuck Schumer trying to put it on the Republicans. But, what we know is that they did try to come to the table, right? They said that they wanted to meet with Trump. Trump initially said no, then met with them the other day. But this came to a head last night with this government shutting down just actually minutes ago. It'll take Republicans, Democrats working together and coming to some kind of consensus to make sure that this doesn't last for as long, as it did in 2018, as you said.
Outside of the human impact, Miles, what's some of the concern, especially if we take a look at some of the data you were mentioning that might not come out? What are you hearing from your sources?
Yeah, I mean, the last shutdown lasted 5 weeks and costed billions. And, we already know that, there are a number of Americans struggling. And when you look at the federal workforce that's already been decimated by DOGE cuts, there's a lot of U.S. data that is going to be delayed, and it's going to be delayed because those people who compile that data won't be in office. You're seeing it on your screen there. Initial jobless claims expected to come out. Those will be delayed. Non-farm payrolls expected to come out. Those will be delayed. Same with CPI, retail sales, and PPI. But this really gets to the chaos that's been happening in Washington. Again, one-party rule, and Democrats trying to push back and try as they might to do anything to, fight back against what they see as real issues for them, and not trying to budge in any direction. That's what led to what happened just a few minutes ago.
Certainly plenty more to follow along with this story. Thanks so much, Bloomberg's Miles Miller, for starting us off, though, on our breaking story for the morning. Let's, though, check in on how markets in Asia are faring. Min Lo is standing by in our Hong Kong studio to dig into that. Min, what are you watching?
Hey Jen, so Asia Pacific is starting off a bit on the back foot here in the new quarter, and the Nikkei certainly is dragging the regional benchmark down. TAIEX, though, is pretty resilient given the geopolitical news we got today, with the Vice Premier saying that Taiwan has never promised the U.S. to help it produce at least half of its chips locally. But we'll talk about Japan because that's the focus here today. The Tenkan survey was out, bang in line with estimates, and that really gives the confidence that the BOJ needs to hike rates in October. And you can see here the yields are largely pointing up. We're looking out for the flattening of the yield curve. Of course, it's going to impact the insurers, the banks, stocks as well, and real estate stocks. Those are the biggest losers on the topics today. But flip the board, take a look at some of the mining stocks that we're watching today. Two particular commodities that are moving in Asia. One, so here we have the Japanese yen as well. But yes, mining stocks, we are looking at iron ore as well as a lithium, because BHP, that's the stock in focus. China reportedly halting shipments of BHP iron ore, with Albanese expressing his disappointment at that, and that's because of a price dispute between the two countries. And here we have BHP slipping by about 1.8%, but some of the other rivals, though, Rio Tinto, Fortescue, doing much better. Liontown is a lithium stock that is falling by about 10% or so. This is after China had reportedly approved a reserves report from CATL, which puts the company one step closer to resuming mining operations in China. And that's why we are seeing the lithium prices possibly going to retract on the back of this.
Thanks so much, Min Lo in Hong Kong for us. We'll check back in with you in just a bit. Let's stick with the markets, though. U.S. stock futures are lower as investors worry that a delay in the release of Friday's jobs data could trigger a correction. Gold continues to set records, though, while bond traders boost bets on a 10-year rally. Joining us now is Morgan Stanley senior global economist Rajeev Sibal. Rajeev, thanks so much for being with us today. Maybe let's just start with the shutdown and potentially the biggest risk that you see coming as we're just a few minutes into it at this point.
Yeah, thank you for having me. I think, as you team has highlighted, the delay in the release of data is going to be critically important here. There are historical precedents that have seen data sometimes released during government shutdowns, sometimes not released. In this case, the BLS has gone ahead and stated that they will not be releasing the data. And as is important for investors in understanding what's happening in the economy, without that information, there's going to be a lot of uncertainty. And we're in an environment where we've had consistent growth, upside surprise, and the market is looking for more of that. And so I think, not having non-farm payrolls, not having retail sales could be, I guess, a bit of a wobble for markets.
What does that mean then for potentially the direction of the Fed? We've heard quite a bit of Fed speak over the past few days. There still is some concern about the labor market. Do you see a continued concern to be telegraphed by a number of these Fed speakers?
Our view is that the Fed is going to stay on course. We think that, in a lack of new information, the Fed has to take the information that they have. We have this combination of relatively strong Q2 GDP print that came out after revisions very recently, but continued deterioration in the labor market. And the labor market has been their focus. And so, all else equal, we think the Fed continues on their path of further cuts. The median and the dot plot was a little bit of a debate between 2 or 3 cuts, but leaning towards 3 cuts. And so we believe that October will carry on if we don't have any further information.
Is there still concern over tariffs? In your report, you point out that it's been about 6 months since we did get that so-called Liberation Day. Has that subsided?
Yeah, so I think this is one of the big areas where not having data will become very, very important. Our view at Morgan Stanley is that in Q4 you'll start to see some of the effects of tariffs more visibly in the data. So far, what we've seen is headline data that doesn't show a lot of effects from tariffs, but micro data that does. You can see in the disaggregation of some of the recent prints on PPI, retail sales, GDP, that the pressures from tariffs are starting to come through. And so not having the data into Q4 could be a problem, because we do suspect that the Q4 data series will start to more clearly show and more visibly show at the headline level some of the tariff impacts. We have to remember that, when forecasts were made earlier in the year, the expectation was that tariffs would be applied in April. And if you put the standard delays from the application of tariffs towards economic data, you get towards a time period of September when some market participants were expecting some of that tariff effect in the data. Because tariffs were applied over time through to August, the real effect of tariffs is probably going to be phased over a period of few months, similar to the time period in which they were applied. And that's why we think that it's the September to December timeframe when we would get the standard lag and push through to headline data. And so we do expect that the worst of tariffs, so to speak, is still ahead of us, even if it may not be as bad as initially expected.
Does that mean a correction, Rajeev?
I don't know what it means for equity markets. Equity markets have had a tendency to look through some of the short-term data volatility. I do think at this current moment in time, with having had a consistent period of growth upside surprise, if you have some downside surprise, you could see a period of volatility, or at least a break in some of the pattern that we've seen for the past few months. The question will be is how widespread is the tariff slowdown? We don't think that it pushes inflation quite as high as we would have initially expected, but it could have a material effect on the jobs market. And that's why not having non-farms on Friday becomes really, really important. We also have to be focused on non-farms data into November and December, because the tea leaves from tariffs will be visible in the non-farms data, as well as some of the retail sales print that we would be expecting from the BLS.
Rajeev, do we see any parts of the global market potentially being absolved of some of what we're seeing in the U.S.? I wonder if you take a look at the data, are you seeing in Asia or Europe potentially some green shoots despite some of the concern you see ahead?
Yeah, indeed, in Europe and Asia, data has been relatively strong. We've seen relatively resilient domestic demand in both of those regions, although in China we're starting to see a deceleration as the fiscal stimulus fades a little bit and we start planning for the next 5-year plan. I think the bigger question for us is more about whether or not tariffs are going to start hitting the export data. We've seen in Japan, we've seen in China, and appearingly starting to see in the manufacturing PMIs in the euro area slight downshift from where the level of exports had been earlier in the year. And so we view this as early signals of some of the headwinds from tariffs becoming firmer in the market and potentially leading what could be happening in the U.S. So our overall expectation for Asia and Europe is that exports could face some headwinds over the next few months, but that domestic demand should remain relatively resilient, or at least versus expectations.
Fascinating insights. We'll leave it there. The Rajeev Sibal, Morgan Stanley senior global economist, joining us in our Dubai studio. Thanks so much, Rajeev. Great to have you. Now, coming up, we shift to the Middle East. U.S. President Donald Trump's new plan to end the war in Gaza is essentially an ultimatum to Hamas. We are live in Jerusalem with what to expect next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Let's take a quick check on equity futures as the government shutdown, U.S. government goes into shutdown just a few minutes into that. The first shutdown in 7 years, Republicans and Democrats, as we mentioned, unable to reach a deal on continuing funding, largely over health care spending, as we spoke with our reporter Miles Miller about that. And just a look at where we see U.S. equity futures clearly taking a bit of a hit right now, trading in the red with S&P futures down just over 0.4%. NASDAQ 100 futures also down just about 0.5% there. And potentially we start to see more impacts as the reality of a shutdown starts to settle in. The treasuries, though, not a bit flat at the moment right now. Yields marginally down, but not showing too much right now, although we are going to continue to watch how cross assets are reacting as the shutdown, again, continues to settle in. Let's, though, move to the Middle East and talk about our top story there. Qatar says it has handed President Trump's Gaza peace plan to Hamas. The foreign ministry in Doha says the group has promised to consider it in good faith. Trump warned Hamas it has 3 to 4 days to consider the offer or face severe consequences. Let's go to Jerusalem now and speak with Bloomberg's Dan Williams. Dan, what is your expectation for how Hamas might respond to this and whether or not they're going to respond in this time frame that they've been given?
I think there's actually a considerable chance they will respond within the time frame and respond positively. The onus has clearly shifted onto Hamas in the eyes not only of Israel. Obviously, Israel wants to finish up this war with what it could describe as a victory, but also of the US president, a president who's broken with past administrations by allowing his aides to speak directly to Hamas, which is designated as a terrorist group in the West. And now we have the major stakeholders in the Muslim and Arab world pressing Hamas directly and publicly. That's Qatar, where the Hamas leadership is hosted outside Gaza, and with the inclusion of Egypt, a major power player, a country which borders the Gaza Strip, and even Turkey, which sent its intelligence chief to take part in these talks in Doha. There's a lot of pressure on Hamas, and that's what makes this different. The number of stakeholders who are publicly lining up behind this deal, wanting to see this war over, ideally a war that would end before it reaches its 2-year mark, just 6 days from now. So I think Hamas will be experiencing a degree of pressure and isolation it hasn't experienced before, and I think the chances are good that it will accept the deal, possibly with some requests for revisions.
Bloomberg's Dan Williams in Jerusalem with the latest in the Middle East. Dan, thanks as always for your reporting. Now, coming up, Zimbabwe's energy minister says global firms from the U.S. to the Middle East are now eyeing the country's vast coal and gas reserves. More details on our interview with the minister next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Zimbabwe's energy sector is drawing fresh attention from global players, with the U.S. and other Western nations now weighing investments in a market long dominated by China. I spoke with Energy Minister July Moyo, and he tells me that there is quite a bit of interest and that the government is now focused on securing investment that will turn discoveries into real supply for the industry. Take a listen.
We have been having exploration by Australian company in gas and oil in our northeast, and the gas findings are looking very, very good. And what we now need are investment in beneficiation that will contribute to our gas supply in many industries, but particularly in electricity. And so we look forward to that. In addition, we have coal bed methane gas, which has been partially explored. And when I was in New York last week, the Minister of Finance and I were discussing with the investors who want to look at coal bed methane gas. We have plenty of it also. And we think that will also bring in the gas sector.
What sort of investors were you speaking to in New York?
In New York, we're speaking to standalone funds as well as corporate funds from non-multilateral funds. We are not accessing funds from ADB or World Bank except for administrative and or feasibility studies because of our situation. But there are funders, including the African Afro-Exim Bank and other banks who are willing to fund us. Qatar is one of them which is looking at funding us.
Have any of those funds been dispersed from the Qataris?
Well, Afro-Exim Bank has been dispersing to us.
That's a Frexim, but the Qataris specifically?
Not yet.
Not yet.
Not yet.
Do you have a timeline for when that might happen?
I cannot give you timeline, but I know that negotiations with the Ministry of Finance and our Mutapa Fund, those are now taking place, and we hope that they will bear fruit.
Do you expect to receive those funds?
We expect to receive.
You do?
Yeah.
And so then what would that mean for the investment into Zimbabwe's energy sector?
I think the chances from our discussions, we had an outreach in New York, we had an outreach in Washington, we had an outreach in London, and some of the investors, for instance, in solar, from our London meetings, once we signed here in Cape Town, we signed a government project support agreement with the British, and that has energized some of the British companies and other companies from all over to come and invest. And besides, our regime for de-risking was supported by the African Union, which gave us lawyers who could look at our regime and say, how can we strengthen to give confidence to investors?
That was Zimbabwe's Energy Minister, July Moyo, speaking with us at Africa Energy Week. Now, let's take a look at some of the other stories we are following from across the region. South Africa's ambassador to France, Nathi Mthethwa, has died in Paris. The 58-year-old former police minister was found outside a hotel after a fall from the 22nd floor. French prosecutors say a window had been forced open and he'd made a troubling call to his wife in which he expressed his intention to take his own life. And Nigeria is downplaying the impact of a strike at billionaire Aliko Dangote's massive oil refinery. The walkout by senior oil workers protesting alleged dismissals aims to disrupt crude supply up to the 650,000 barrels a day. Regulators say operations remain stable and talks with the union are underway with hopes of resolving the dispute within 72 hours. A prolonged shutdown, however, could threaten Nigeria's crude production and fuel supplies. Now, coming up, Saudi Arabia is expected to run a deeper budget deficit this year than previously expected. We have the details on that next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Shut down. The U.S. government goes dark after Congress fails to reach an agreement after Democrats rejected a stopgap funding package that did not address its demands. Bloomberg has learned that OPEC Plus is planning to discuss fast-tracking its latest round of supply hikes in a bid to recoup market share. And weaker oil prices weigh on Saudi Arabia's economy, the kingdom now projecting a deeper budget deficit this year than previously expected. It's just gone past 8:30 a.m. across the Emirates, 6:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. And of course, as we've been speaking about this whole hour, the U.S. shutdown, government shutdown, really top of mind for a number of investors. It's been just about 7 years since we saw the last shutdown. There have been a number of false starts for a shutdown over the past few years, but this is really the first that we have seen, and seeing a bit of price action, at least in U.S. equity futures, slipping a bit just as the reality of a government shutdown sinks in. S&P futures down just over 0.4%. The U.S. 10-year yield largely unchanged right now, but marginally lower with the 10-year yield at 4.1464 there. Brent crude crude, we're going to be speaking about oil in just a few minutes, but we are seeing Brent crude slightly stronger on the day, up just over 0.2% there. But of course, we do have that OPEC Plus meeting coming in just a few days, and potentially we do see the bloc actually bringing more barrels back onto the market. So how that could affect prices is something to watch for. Brent crude, though, trading at about $66.22 a barrel, and gold largely unchanged, although we have been speaking over the past few days about the records we've been seeing with the yellow metal, especially as this looming shutdown and more investors seeking haven demand increases. Right now, spot gold at just about $3,859 an ounce there. Let's dig in more, though, into our top story, and that is the shutdown. We have Bloomberg's Miles Miller, who is following the story for us. Miles, give us some insight into really what the impasse is between Democrats and Republicans and how we got to this point.
Yeah, so this really came down to a showdown between Democrats and Republicans. It's a political standoff with the Senate failing to pass a temporary extension of funding. What we know is that Democrats blocked a Republican plan, saying it didn't include health care provisions, and these were critical provisions that they said they wanted to extend subsidies as it related to the Affordable Care Act. Now, Republicans, including President Donald Trump, refused to make those concessions, and the government shut down at midnight Washington time. What we know is that this has a big effect globally, money and markets front and center, with the shutdown meaning that some of this economic data, key economic data, whether it be the jobs numbers or inflation reports or GDP, all will take some time to come out, and that's because the folks who prepare those economic reports have been furloughed. Among the 750,000 government workers who will be without a job because of this. Now, what we know is that those statistics, of course, don't just drive decisions in Washington, but they have a major effect globally, and investors globally are relying on those signals as they make key decisions. They use those signals to gauge the direction of U.S. interest rates, of course, as well, and without them, the Federal Reserve has less guidance, which, of course, means that markets are going to be partially flying blind as all of this continues. But, U.S. government operations will continue around the world. They'll be disrupted in some instances, but they will largely continue. Consular services, visa services will continue, as well as counterterrorism assistance and assistance programs across Africa and the Middle East as well. So this could drag on for quite some time. The last one lasted for 5 weeks. We'll see how long this one lasts.
Yeah, Miles, can you give us some precedent, historical precedent, if you can? It's been 7 years since we saw the last shutdown. What could we potentially see with this one?
Yeah, let's take you back to 2018 and 2019, the last time that we had a government shutdown in the United States. It lasted 5 weeks. Both sides were dug in there as well. But this will have to end with concessions, the Democrats having to give up something and the Republicans having to give up something as well. But the Democrats are certainly dug in as it relates to those Obamacare and health care subsidies. They want to see no cuts to Medicare and Medicaid. And so if that doesn't happen, you could see this drag on for some time. Very early on, Democrats came to the table and said that they wanted to meet with President Donald Trump. He initially said he was not interested in meeting with them. Then began the days of talks, and then it led to where we are today, the government actually shutting down at the strike of midnight Washington time. It'll take those concessions in order to get this fixed. And, we knew that this shutdown was going to happen because Mike Johnson, the House Speaker, decided to send his body home, which meant that once the Senate passed or worked on that stopgap measure, no matter which way it went, pass or fail, there was never going to be a way for the House to vote on it. This will take some days, and unfortunately, because of that, that means that the government is shut down, and 750,000 people who work for the federal government have no jobs, will have no paycheck come time to be paid.
Thanks so much. Bloomberg's Miles Miller joining us from London with our top story on the U.S. government shutdown. Appreciate it. We also have some more breaking news coming into the newsroom, and that is, of course, the Reserve Bank of India's policy decision. We had been watching closely for it all morning, all day, and we are being told that the RBI leaving their key rate at 5.5%. And as we had been speaking about, a majority of the economists actually polled by Bloomberg had predicted potentially we were going to see the RBI remaining on hold, and a number of them citing India's darkening growth prospects. Although we are hearing from the RBI on the fiscal year 2026 growth outlook actually revised upwards, is what they're saying. And they're also indicating that 10-year bonds, or we're seeing India 10-year bonds reversing their gains. The RBI is saying that the impact of front-loaded policy is still playing out and still waiting for the impact of monetary and fiscal actions to play out. But that is the decision from the RBI just a few minutes ago. Now, let's turn back to the Middle East. Bloomberg has learned that OPEC Plus is planning to discuss fast-tracking its latest round of supply hikes in 3 monthly installments of about 500,000 barrels a day. Saudi Arabia and its partners will reportedly review the expedited return when they meet on Sunday. Let's bring in Stuart Livingston-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia. Stuart, give us some indication or some insight into why you think the group is expediting the return of these barrels.
Good morning, Jennifer. Yeah, so I mean, I think it's in some respects a continuation of that change of direction that you've seen over the last several months. And it's an acceleration. And I think that is largely going to be driven by the larger members, notably Saudi Arabia, that I think have come to the conclusion that for many months, if not years, they had effectively ceded market share in an attempt to get the price up. And ultimately, the calculus here is that they can produce oil at a much, much cheaper rate than, say, competitors in the US, notably, that have been taking that market share in Asia. And they can put up with that for much longer. Now, there may be some short-term economic pain in that, but they, I think, have their eye now on the long-term future. They can basically outproduce anyone else. Probably the last barrel ever pumped will come out of this region. And they're taking the view that they're no longer going to cede market share for the benefit of the entire industry with higher prices.
Is the expectation, Stuart, then we'll see prices continue to lower? Right now, they're actually, Brent crude is up just about 0.3%. But is the expectation then we'll see a continued drop in prices?
I mean, we may see it slightly lower if you look at the sort of, I mean, I suppose two things to look at. Number one is the forecast that we have. So the consensus is for lower oil prices of about $5 next year or thereabouts relative to the average of this year. And then, you know, that increases again the year after that. So in relative terms, yes, you may see lower prices somewhat, but it's hardly going to be a collapse in the market based on the forecast that we have there now. And again, for Saudi Arabia and for the oil market at large, we're in the mid-60s now for Brent, which looks low relative to a couple of years ago. But, you know, I remind everyone that is roughly what the average has been over the last 25 years or so. So $65 a barrel is not a terrible price. It's lower than what Saudi Arabia needs to break even in terms of its budget. And again, as you mentioned earlier, you've seen an increase in the estimate for what the deficit will be this year. But again, the calculus there has to be that they can endure that pain, if we can call it that, for longer than, say, the US shale producers. So I think that's really what's going through everyone's head right now.
We'll see how that meeting plays out. Stuart Livingston-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia, joining us there in Dubai. Stuart, thanks as always. Now, those lower prices are seen pressuring some of the region's main economies, as we were just speaking to Stuart about. Saudi Arabia is projecting it will run a deeper budget deficit this year than previously expected. The kingdom is spending heavily on its economic transformation while grappling with the effects of weak oil prices. Let's now bring in Abir Abu Omar, Bloomberg's deputy UAE bureau chief. Abir, give us a run through of some of the numbers in this pre-budget for this year for Saudi Arabia.
Good morning, Jen. So yes, the deficit, as Stuart has alluded to just a few moments ago, has come in wider than expected, actually almost double what the initial estimates by Saudi Arabia were last year. That's at about 5.3% of gross domestic product, or about 245 billion riyals. The equation is simple, right? Spending came in higher than expected, a little bit higher than expected, and revenue is a little bit lower than expected. And that equation is also, simple if you want to look at it. In hindsight, it's practically a product of lower oil prices. Now, Saudi has been going on this major diversification push over the past 8 years, and it's seen massive progress. For example, we know that the non-oil industry is contributing to more than half to real GDP in Saudi Arabia, but still oil is a determining factor. I bring back what Stuart said about the break-even oil price. Now, the fiscal break-even oil price for Saudi Arabia, according to our Bloomberg Economics team, is at $94 a barrel. That goes up to 111 if spending by the PIF, that's the Saudi Sovereign Wealth Fund, is taken into account. And as we have mentioned, Brent right now is at an average of $65 a barrel. It's down 10% for the year. We've seen the story about the OPEC, OPEC bringing back some supply into the market. That's bound to have some impact on prices. So it's not a good story for Saudi Arabia. But the expectation for a deficit and the doubling of the deficit to 5.3 from an estimate of just above 2% earlier has been widely expected by the IMF, by economists. And so Saudi has really sort of stuck to the estimates that external institutions have put through.
What does this mean, Abir, for the coming years? We were just showing a chart for some of the expectations. What insight can you give into that?
So the deficits are expected to run through until 2028. They're expected to lessen into the next 3 years. We know that is going to happen. But what we know about next year is that Saudi has sort of put its fiscal discipline goals. It's put it through until next year. We know that it's increased spending a little bit this year for the full year 2025 budget. 2026, it's planning to reduce spending, and that's a good sign, right? Every external institution, economists, analysts have been calling for Saudi Arabia to reduce its spending and rationalize. Again, I mentioned this word quite a bit when I talk to you guys, but rationalize spending, especially on the giga projects. We've written multiple stories about NEOM. We've written multiple stories about, the sort of rationalization that is happening there, and that is seen as a positive sign by the market. And so Saudi has to put in more work towards that, more work towards rationalization, and towards reducing spending. That's a little bit contested by some of the economists that we have spoken to, who say actually reducing spending by as much as Saudi is predicting might not actually be doable, but we have next year to see.
Certainly, and you to report on that for us and bring us some of that reporting. Abir Abu Omar, Bloomberg's Deputy UAE Bureau Chief. Abir, thanks so much for your reporting. Now, coming up, engineering and construction company ALEC Holdings is preparing for a listing on Dubai's exchange. We'll discuss the IPO pricing with CEO Barry Lewis next. This is Bloomberg. Demand for Dubai engineering and construction firm ALEC Holdings listing on the Dubai Exchange has been strong, with IPO books oversubscribed. The listing, priced at 1 dirham 40 fils per share, is at the top end of the range. Joining us now from our Dubai studio is the CEO, Barry Lewis. Barry, thanks so much for being with us. Let's just start here with the IPO book. Talk about some of the investors that have been interested in the IPO and give us some insight into what it looks like over the next few weeks and months.
We've been very happy with the response that we've had. We've had a big interest from international, regional and local investors. So, I mean, we're very comfortable with where we are. We've had a demand of around about the 30 billion, so 21 times coverage. So we see that as a very positive indication that people see the exciting growth story that we have to bring to the market.
Would you say there are more investors regionally, or are you seeing international investors potentially being even more prominent than the regional investors?
I think we've had a good mix. We've had a lot of long-stay investors coming out of some of the asset management entities within the overseas markets, and then also very strong demand from the region and also the family offices.
Barry, talk about some of the projects that you have on tap within the UAE, but also around the Gulf.
So our two primary markets of operation are the UAE and Saudi Arabia. We've built the business on the back of building large, iconic projects in the region. So some of our landmark projects is one's the Wheel project that we delivered. We've done a lot of work in the aviation sector. So Dubai Airport Concourse A and Concourse D have been delivered by us. And we see this at the moment. We're in a very exciting market both here and in Saudi Arabia.
Can you talk about excitement, though? Because some people would say that we're seeing a bit of a property bubble, at least if you talk about the UAE. Describe excitement for us and what that looks like for the business.
So our sectors of operation are large-scale iconic building and construction operations, the energy sector, and then also the aviation sector. So between Saudi Arabia and Dubai, I mean, in Saudi Arabia, our addressable market sits at about 4.3 trillion Saudi riyals, and our addressable market in those three sectors here within the UAE sits at about $2.3 trillion. So the aviation sector, there's a massive push in Saudi Arabia and in the UAE, and then that's an area of our expertise. We're also seeing that in the data center space regionally, there's a massive spend. And so we're very well placed based on our 26-year track record to capitalize on a lot of those up-and-coming projects. So we're excited and well positioned.
Who are some of the partners you're working with for those data centers?
So the regional players in the market is within Saudi Arabia. There's 2 or 3 entities that have been created, and here within the UAE. There's also under the G42 drive. So, and also there's, national agendas that are driving the AI initiatives.
Does that potentially mean there's some acquisitions in the pipeline, or do you plan to work with the G42s and others to get some of these projects off the ground?
So, I mean, we don't have any acquisitions on the horizon at the moment. And as a business, our strategy, with the exception of the acquisition of Target in 2022, is to generally grow businesses organically. So at the moment, there's nothing on the horizon, and we have the ability to scale and build the capacity internally, capitalizing on our already existing large base.
All right, we'll leave it there. Appreciate you joining us, though. ALEC Holdings CEO Barry Lewis, they're joining us just ahead of the company's IPO. Thanks so much, Barry. Now, Amazon has unveiled an updated line of products to take on Apple in the AI era. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Amazon has unveiled an updated line of products aimed at challenging Apple in the AI era. The company introduced enhanced smart speakers, e-book readers, and TV accessories, all powered by AI and integrated with Alexa Plus. Amazon's Senior Vice President of Devices and Services, Panos Panay, spoke to Bloomberg about its latest offerings.
A lot of times we take out our phone, we get distracted. I'm at the dinner table with my kids. We have this idea that we want to keep our phones down, right? Because we want to be present with each other. And there's so many times where you pull out your phone to answer a question, almost like you just said. But now it's just changed. It's completely different. Just say, Alexa, have the conversation. It's quite literally all the information there, and it's conversational. Not only that, she can then get the next thing done for you.
Bloomberg's Mark Gurman has written, and it's based in part on a conversation with you, that Amazon's overhauling its devices to take on Apple in this AI era. Do you agree with that?
I haven't seen it, Ed. Can I say that? Let me read that article. Then, here's what I'd say. We build our products for our customers and for people. My whole goal is quite simple. We want AI to be useful for people. End of story. And I think we're building devices to do just that. And I do believe they're beautiful. I think they fit in the home. I think they're so well thought through that when people use these devices, Ed, they're going to love them. They're just going to love them. I can't, this is something I just want people to get their hands on them.
Amazon Senior Vice President of Devices and Services, Panos Panay, speaking with Bloomberg's Ed Ludlow. Now, let's just take a look at where we are at for our markets right now, and especially given the reality that the U.S. government is now officially in a shutdown after we did see Republicans and Democrats disagree on some of the main points, especially healthcare. If we take a look at U.S. equity futures slipping there, S&P futures down just over 0.4%. NASDAQ 100 futures also down right now. Eurostock 50 futures, though, relatively flat, although we are watching closely what this means. And as our Miles Miller was pointing out earlier, how long this could actually potentially go on for, especially given it's been about 7 years since we saw the last shutdown. Let's also take a look at, but actually, I think we're going to leave it there. But that is it for Horizons Middle East and Africa. Busy morning for us here. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak. You're up for more coverage. This is Bloomberg.